Oh la la. Okay, so I'm going to start over. Mm. My name is Yemisi Legushe. I'm licensed security advisor, and we are talking about tax deductible accounts today. Tax deductible accounts. So the reason why you see me on social media is because I'm self-employed financial advisor, and it means I work with several companies at the same time. So if you don't want just, hey Philip, how are you? You just don't want old information, or you don't want information that is peculiar to just one option, and you want to work with someone that can give you comprehensive information that is not just restricted to just one company, then I'm the person to reach out to. Um my name is Yemi Sidebushi. I'm a licensed financial advisor. So the topic, I see your question. I'm going to take that question. So the topic is tax deductible account. We have two types of tax deductible accounts. These accounts, you need to know them because it helps you towards your tax refund. FHSA and RRSP are both tax deductible accounts. FHSA, you're eligible to open FHSA if you are 18 and above, you have a social insurance number, you have a work permit. So whether you have open work permit, closed work permit, and a permanent resident, a citizen, if you want to open FHSA, you are eligible to have it. Or you had a house before, you had a property before, but you sold it for whatever reason, and in the last 5 years, you don't own a house or a property or an apartment in your name, then you are eligible to open first home savings account. Like now, I'm talking about how much are you allowed to put inside first home savings account. How much? You're allowed to put in 8,000 the first year. If you are someone in a position where you are able to put in 8,000 in your FHSA every single year, let me see. Philip, do you want to tell me something? He's coming in and out. I let me go on. 1 minute. Okay. Let's see. I think he wanted me to. Okay, he ended his life. Okay, no problem. Okay, so it is 8,000 per year maximum. That you see, the word maximum does not mean you must put in 8,000. It means that is the maximum. So whether you want to put in $25, $100, 5,000, 2,000, but the maximum in 1 year that you are able to put into your FHSA is 8,000. Okay, so that also means, let's say this year you were only able to put in 4,000 into your FHSA. The 4,000 that is not up to the maximum, you can roll it over to the next year. So by next year, you're able to put in the 4,000 you did not do this year, and then the 8,000 for the following year, you're able to do that. But now, let's say you're someone that you are able to put in 8,000 every single year into your FHSA. Maybe you are just 27, you are working, you are still looking to marry before you buy your property, or you are not even looking to marry, you're looking to just rent for some time so that you can accumulate your down payment. You are eligible to have 40,000 in your FHSA for 5 years. So 8,000 every single year. Within 5 years, you have maxed out the total, which is $40,000. But if you are someone that you put in 3,000 this year, 4,000 next year, you still have a lot of time. From the year you open FHSA, you have 15 years to keep it open. You have 15 years to keep your first home savings account open, right? So the reason why we are having this conversation now is so that you can know what you're supposed to do this year before it is 2027 and you say nobody told you. I don't want that. I don't want that at all. So what can you do if you are looking to buy your first house in Canada in the next 6 years, 6 months, 1 year, 2 years? You know you want to buy. You're already saving and investing, and the money you want to use to buy that property is in a savings account or a checking account. You have not done something right. You have to put that amount of money in your first home savings account. The benefit is that your first home savings account, the amount of money you put there, you can use it to file taxes, and that can help you get tax refund. But even if you have, yes, if you don't use that money in your FHSA to buy a property and you don't want to pay taxes, okay, you don't need it for any emergency, you can transfer it into your RRSP. But if you take the money out of your FHSA to do any other thing, whether for Father Christmas, Mother Christmas, Bonanza, Black Friday, village people, whatever, so far you take out the money and you use it for something else apart from buying that house or buying your first house, your first apartment, whatever you want to buy, you take out that money and you don't fill out the form called RC725, or you just take out the money for any other thing apart from buying that property, you are welcome to the land of taxes. CRA is happily going to be happy, and they are happily going to deduct your taxes, which is called withholding taxes. So I hope this helps you to make an informed decision. So taking money from, so I'm going to go ahead and answer the questions that I have here. Taking money from your TFSA, will they tax me? No, part. Anything you do with your TFSA is okay, except you do these two things. You put more than what you're allowed in your TFSA, or you do day trading in your TFSA. That makes it a taxable account. Makes sense? Part, tax free savings account. So you are taking me back to what I don't want to talk about today, but that's okay because today is it the same amount of tax as your marginal? Please talk about the withholding taxes. Okay, so part. So let me answer the question related to the topic. TFSA is not a tax deductible account. So I'm trying to avoid that question because it's going to be confusing. So withholding taxes, the word withholding. So if you deduct from your FHSA and you're not using to buy a property and you have no option, you just want to take out that money, it is called withholding taxes. Yes, FHSA, first home savings account. So withholding taxes means the financial institution that you use for your FHSA, they are the ones to deduct the taxes, right? So let's say you want to take out 5,000 from your FHSA. That money you are not using it to buy your first house, and you are not, it's only first house. What happens is that if you have just 5,000 in the account, they cannot give you 5,000. That is what it means. They have to take 20% of that 5,000. Whatever is left is what gets paid back to you. But if you have more than 5,000 in your FHSA and you really want 5,000, what happens is the leftover in your TFSA, they have to take 20% from the leftover in your FHSA. That is what is called withholding taxes. So you pay withholding taxes on FHSA and RRSP. Why? RRSP too, if you touch that RRSP before retirement, you are going to pay taxes because RRSP is for retirement. There are only two ways to touch the RRSP without paying taxes. Only two. You want to use the money in your RRSP, registered retirement savings plan, to buy your first property, or you want to use the money in your RRSP to go to school. Okay, those options you are allowed to touch your RRSP. Remember, see, all these accounts, you have to understand the characteristic, or else you will just be giving out free money to CRA, and CRA is going to happily tax you. So the way I like to explain RRSP is very simple so that you are able to understand. I have seen people that get angry because uh, they set up their RRSP with a financial institution. When they met me, I was telling them, and they were like, I was told. So that's why we are having this conversation. RRSP, you need to know the characteristic. The money you put into RRSP is for your retirement. That is why it is called registered retirement savings plan. It is for your retirement. That means the money you put there is going to be invested based on the portfolio you selected. Whether you do ETF, you invest in shares, you do mutual funds, seg funds, I can help you set it up if you're interested. But that money in that account does not belong to you until retirement. But they have actually given you two options to touch the money in the RRSP before retirement. So to make this statement make sense, even though they have allowed you to touch the money in your RRSP to buy your first house and to go to school, they've allowed you to do that. You still have to put the money back. So you still have to, that is why that's why I always use that statement that the money in your RRSP does not belong to you until retirement. If you want to put money and you know that that money you don't need it, fantastic. You enjoy the tax refund, make sure that the RRSP is invested at least at 12%, 20% on average year over year, then you are doing well. But at least you'll be ready for the taxes in the future, which is also going to be based on your marginal tax rate. There is one common statement that I hear, and sometimes I just smile, I nod my head because see, when it comes to money and taxes, please work with somebody that can somebody that is knowledgeable. Okay, marginal tax. There's a common statement that says, okay, in the future, the taxes you pay on your RRSP is going to be lower than now. It is true, but not true for everybody. It is true, but not true for everybody. I promise you. So if you're someone you love to accumulate skills, do two, three jobs, before you know at age 60 you are earning 200,000, 300,000 from your income, rental income, two jobs, three jobs, consulting job, whatever. And as the time you retire, you are also considered a high income earner. I'm sorry to break your bubble. Your taxes on your RSP is still going to be high. Also, let me ask, aside withholding taxes, I also suppose you will pay another tax because any money withdrawn that is not could be considered as an income and you will pay income taxes. So the taxes is still income. Samarao, Samarao. It is still withholding taxes. If you take out money from your RSP and you don't use it to buy a home, yes, it is still taxed. It is called withholding taxes, right? Now the tax percentage is based on your marginal tax rate. I think that's what you are saying now. Okay, I hope that is clear enough. Can you advise me how where to invest 200,000? Senior Phillips. So, senior prophet Stanley. Okay. So there are several questions. I don't know if you are able to answer that question. I don't know if you are senior prophets. There are so many. I can't tell you do this, do this, do that. No, I have to ask you some questions before I can advise you. So if you are not shy and you are in a good place to talk, put yes in the chat. I have so many questions to ask you. That is a very good question. So if you are able to send in your request to join the live, I'm able to ask you questions and advise you. So you can't go to a medical doctor and say, give me medication. No, the medical doctor will ask you question, might say you should go and do test. So I'm a money doctor, okay? So I have to ask you questions before I can advise you, okay, invest your money here, invest your money there. I hope this makes sense. Okay, sounds good. So before you invest, there are questions I need to ask you. So inbox. One is, do you need that money? That's the first thing. If you know you don't need that money in the next 6 months, 1 year, 2 years, then that means at least the money is still able to, excuse me, is still able to be invested in volatile investment. But if you say that money you need it in 6 months, you can't do much. You can only do GIC. Okay, so once we have established that, that's the first question. The next thing is, um Do you want to use that money to buy a property, or you just want to invest it for investing sake? If that is the case, then TFSA comes to mind, because the money you put into your TFSA, you have access to it in case there is emergency. It's also going to be invested. So TFSA is an investment account, right? So I hope that helps. So I'm going to go back to the topic that I have today. Okay. I'm talking about tax deductible account. We have two types of tax deductible accounts. We have first home savings account and RRSP. The reason why it is called a tax deductible account is the money you put in that account in the current year, you can declare it when you're filing taxes in the following year, and that can help you to get tax refund. That is the meaning of tax deductible account. Okay, that's the meaning of tax deductible account. So to put this in perspective, if you know that you want to buy a property, an apartment or a house or a home in the next 6 months, 1 year, 2 years, you're already working towards it, you are saving and investing. What you are supposed to do is that type of money that you're putting aside, you should fill up your FHSA, fill it up, because FHSA, first home savings account, you are able to use it when you're filing taxes next year. By God's grace, we are still alive, and then you can be eligible for tax refund. But that same money that you want to use to buy that apartment or a condo, and you put it in a savings account or a checking account, you can't use or declare your savings account or your checking account when you're filing taxes. It doesn't help you in any way. It's not a tax. Your checking account or your savings account, excuse me, is not a tax deductible account. So you can't use it when you're filing taxes next year, and it doesn't help you to get tax refund. That is what it means. But if you know that first home savings account is a tax deductible account, that helps you to get tax refund next year. I hope this is clear enough. So RRSP2 is a tax deductible account, right? So the major challenge with FHSA is that the money you put inside your first home savings account, you can only use it to buy a property, your first property, whether it's a first apartment or a first house. That is what that account is designed for. If life happens and you need that money and you are not using it to buy that house, CRA is going to tax you. Now, let's assume you actually put in money there over a couple of years and you're ready to take out the money, right? You still have to fill a form called RC725. If you don't know this information and you take out money from your RRSP without filling that form, CRA will not say, we know that you don't know, we pardon you. They will still tax you. They will still tax you. So ignorance is not an excuse. So you have to know these basic things. It's basic, but some people don't know it and they end up paying a lot of money as taxes to CRA. Madam Julia is here. How are you doing? Mama T, do you have any question for me? Funde, Clarice, Joshi, Kazim, Part 23. Do you have any question for me? Rick Moses. Let me know. Do you have any question before I go to the next topic? Hmm. Kazim, I hope I answered your question. Okay, no question in the chat. Okay, so for tax deductible expenses, I said today I'm just going to mention two. I'm just going to mention two. One, moving expenses, and then medical expenses. You can claim it on your income taxes. I don't file taxes. I don't do, and I don't have intention to do it. I'm not a I don't want to do it. It's not as if I cannot, but I intentionally don't want to do it. I don't file taxes, but I can tell you a lot of things that you need to know ahead of filing your taxes. So let me start from moving expenses. If you moved from this apartment to another apartment for whatsoever reason, And this new apartment, it is closer to where you work, at least 40 kilometers closer to where you work. Then you can claim the expenses. So either you pay the truck to move your furniture, whatever, the the receipt that you use to pay the person or the company, you are supposed to keep it and use it to file taxes. So if you are listening to me, you have moved this year, you have paid and you don't have the receipt, you better go and start knocking on their door and collect the receipt so that you can use it to file taxes. Okay, that is moving expenses for you. But the maximum you can claim is 2,000 for any province. 2,000 for Ontario, it is 3,250 if I'm not mistaken. So that is for moving expenses. I have explained it. You moved from this apartment to your another, you moved and you paid. Okay, where is the receipt? You need a receipt to be able to declare it um, for eligible tax deduction next year. Okay, any other question, please? I see no question. Okay, so that is for moving expenses. So I'm going to share my screen for this particular one, which I mentioned it is medical expenses. It is a lot, and it's not everybody that can claim medical expenses. You are eligible to claim medical expenses if you pay a lot of money for out of pocket medical expenses. Okay, so let me share my screen to explain this. So 1 minute. It's a long list. What you can claim on your income taxes as medical expenses. What you can claim is a lot actually. So let us go. So moving expenses also have conditions. Yes, now where you are moving to, it is closer to where you work. If you are moving farther from where you work, then you cannot claim it. Okay, thank you for asking. So here we go. So we are going to do medical expenses, CRA, and then you go here, medical expenses, CRA, what you can claim on your income taxes. So let's go and so you see eligible medical expenses that you can claim on your return. Medical expenses that you can claim. The list is long, so look at it. If a medical doctor said because of your breathing, I'm just explaining, because of your breathing problem, you need air filter, air purifier. Yeah, if you don't have this situation, God has blessed you, or you cannot, you 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 cannot use a fan. You have to buy an air conditioner because of your health. It doesn't make sense to some people, but I understand. So if a medical professional has told you that you need air purifier, there are some people that they bleed a lot and they will tell them they need air filter, air purifier. So the money you use to buy that, you can claim it on your income taxes. But there is there is a certain amount of money that you must have spent as medical expenses before the extra becomes tax deductible. Okay, if you called an ambulance, whether you are a citizen or you are a permanent resident, you have to pay. So but you can claim it back. So you can see whether you are a citizen or you are a permanent resident and you had to call ambulance, it is tax deductible. Okay. Okay. Excuse me. Excuse me. Now, before you can claim medical expenses, you must have spent at least 2,000, let's say 2,900 on medical expenses. Anything extra, then you can claim it on your medical expense. That's why whenever I'm talking about medical expenses, I always say it's not for everybody. If you spend a lot of money paying out of pocket and prescription medication, you paid for anything on this list. You can see it's a long list. You paid for ambulance during the year, you paid for birth breeding monitor, bone marrow transplant, bathroom aids. You paid for anything on this list. You had to pay for disability tax certificate. So if you don't know all these things, don't worry. God has blessed you. So if you had to pay a medical professional to fill out or complete disability tax credit form, you have to pay them. You can claim it. Um, computer peripherals, cancer treatment. Can you see? So if for some people that say people don't pay money for some treatment, there are some treatment that you have to pay out of pocket, even if you are a citizen or a permanent resident. So it says here, see here, cancer treatment. Cancer treatment in or outside Canada given by a medical professional or a public or licensed private hospital. So there are some treatment you are going to get in some hospitals and they will say you have to pay for it, right? You can read it by yourself. It's not here Mrs. say. So in those cases, you have paid out of pocket. So the receipt you can claim it on your income taxes. Now, dental services. You don't have the government dental plan because your income is high, right? You have to pay a dentist, and you're not doing cosmetic surgery, okay? You have to pay maybe for tooth removal, what they call root canal. Those things are expensive, right? So you can keep the receipt and use it to file taxes. If you use all this, you can see it's a long list. It's a long, that's why I always share my screen when I'm talking about this. Electrotherapy devices, furnace, see the amount you paid for an electric or sealed combustion furnace to replace furnace. This replacement is necessary because of a person's severe chronic respiratory ailment. Prescription is needed. Okay. So now if you are someone or you know someone that has celiac disease, these are people that they cannot eat wheat. If they eat wheat, they have anaphylaxis. And anaphylaxis is a medical condition where you are reacting to a particular food and it could lead to your death. Okay, and you don't eat any food containing gluten, it's expensive. So the receipt that you use to purchase gluten-free foods, you can deduct it on your income taxes, but they have written how that can be done. If you bought a gluten-free food, Madam Fumi, God bless you, thank you. If you bought a gluten-free food for $50 and something similar that contains gluten is $25, you can only deduct 50 minus 25. That is, you can only claim $25 on that particular food on your income taxes, but at least you can claim it. Hospital bed, hospital services, you can claim it on your income taxes. Injection pen, this one is insulin. If you had to pay for your insulin pen, you can deduct it on your income taxes. Then this one, I know this one since 2019. If you do IVF or somebody does IVF, it's not free. The lady that I know that I did IVF, my friend, she paid at least 11,000 for IVF, but she was able to claim it on her income taxes. So the list is long. Now, this is what I'm saying. You must have spent at least 2,800 on your medical bills before you are eligible to deduct the remaining. So let's say you spent 5,000 on medical expenses from January to December. So 5,000 minus 2,890, that is what you are able to claim on your income taxes. Yes, so I don't know if this is, if you have learned something, please put yes in the chat. If you have learned something today, please put YES in the chat. Madam Fumi, thank you. God bless you. YES in the chat. YES in the chat. Okay, the list is long. The list is long. Let me just read some list out. uh, medical services outside Canada. See, if you don't understand these things, just be grateful to God. I know a colleague that had to go to India for breast cancer treatment because the waiting list here was too long. Unfortunately, we lost her. Even after paying air ticket, paying that one, she still passed away. So, some people, you are not grateful for good health. You are not grateful for you have food you can eat safe. You are still grumbling up and down. May God forgive you. See, my eyes are seeing something in this job that I'm doing. Oh my God. If you were to know what some people are going through, you wake up, you sleep, you wake up. In fact, you be the one rolling on the floor. Thank you, Lord. But what are some people doing? They will still complain. God is patient. Oh. Any question, please? Before I change the topic. Any question, any question. If there is no question, let us change the topic. Oh. Mm. There's no topic. Rashid, how are you? Good evening. So I'm going to summarize the topic. There are things you need to know, okay, before you file taxes. One, I'm talking about tax deductible expenses. What are the expenses that is eligible for deduction on your income taxes? Number one is moving expenses. Number two is medical expenses. See, number one, if you move and you paid for that service to move from your apartment to another apartment or from your apartment to your house, so far you moved this year 2025 and you paid for it, okay, keep the receipt. You can use it when you're filing taxes. Then the other option is, if you're someone you have used more than $2,900 to pay for medical expenses, you can deduct it. Okay, you can deduct it on your income taxes, but you must have spent at least $2,900 on medical expenses, whether it is prescription medication. You can't claim over the counter medication. So if you go to a pharmacy and you can pick the medication on the counter, we call that over the counter. So if you go there and buy over the counter, you cannot claim that one. You cannot claim it. It is the medication that a doctor prescribes. If a medical doctor prescribes something, a medication for you, and you have to pay out of pocket for that medication, then that is the medication expense that you can claim. That's the medication expense that you can claim. Okay, I hope that helps. Okay, so we've talked about tax deductible. I'm just going to talk about two. So the reason I'm not going to a lot of details regarding, because I don't file taxes and I don't want you to see me as somebody that files taxes. My job is, I'm a licensed financial security advisor, and my job is to teach you about investment, how taxes affect your investment, what you need to know about retirement, so that when village people are villaging you to buy asoebi, you will not buy asoebi because you know you want to invest for your retirement. Okay, so the choice is yours. If you like, buy asoebi and don't invest for your retirement, in the next 20 years, the report sheet like this is going to be out. The report card for you, the report card for me, the report card for everybody is going to be outside like this. So you buy asoebi because you want to make somebody happy. And then after you wear the asoebi for one or two, you wear it once or twice, you cannot wear it anymore. But that same money you would have invested it and it's still generating dividend for you. It is your choice. If you actually want to impress people that do not care about your future, I can't answer that question for you. Okay, so tax deductible account, we have RRSP and TFSA. So why we are having this discussion now is because if you don't do what you are supposed to do, you will not be able to claim tax refund next year. So if you are listening to me and you know you want to buy a property in the next 6 months, 1 year, 2, 3, 4, 5 years, and you are already saving and investing for that purpose, you are doing it, fine. You are supposed to put that money in FHSA. When you fill it up, you can do other investment. That reminds me, the money you have in your FHSA, you can use it to buy your first house. The money you have in your RRSP, the same thing, you can use it to buy your first house. The major difference is that the money you put inside your FHSA, when you take it out and you fill out the form RC 725, excuse me, when you take it out, you can't put it back. You are not mandated to put it back. But you see, the one that you take out from your RRSP, you've been allowed to take it out. You use it to buy that house. You have to pay it back. You have to. See, the good thing is CRA does not joke with their money. So you cannot tell TRA that I did not know. There's nothing like I did not know. So the money you the money you put inside your RRSP, when you take it out, to buy that first home, CRA expects you to put it back into your RRS because they borrowed you. You will say it is your money, don't worry. It is not your money because that account is for your retirement. So if you are touching the RRSP before retirement, they allow you to touch it to buy your first house. They allow you to touch it to go to school. Under both circumstances, you still have to put it back because the account was actually designed for your retirement. So that's the difference between FHSA and RRSP. So if you want to ask me which one should I set up for the purchase of your home so that you can get tax refund in the following year, is FHSA. When you fill up that one, 8,000 per year, if you can. If you cannot, fine. It is what your capacity can, you can do that you do. But I hope anyway, let me just pause here. Madam Funmi, God bless you. Thank you so much. Some people now we still have to beg before they like. It's not fair. Mama T, do you know that I know your address? Kazim, Clarice, I know your address. Please tell me to like and share. Engineer Kazi, please like and share. Be kind now. God loves a cheerful giver. Just on your phone, just tap on your phone. If you learn something, feel free to like. If you're joining here, Joseph is making fun of happy. You see, that's not what the Bible say. Ah, givers never lack. Sure, I should start quoting Bible verses for you now before you can like. Givers never lack. All you have to do is on your phone, just like you are giving, you are supporting. Give not pass like that. Me that I'm using my, you don't see how I'm stressing. I have to be drinking water. I'm using my time, my knowledge. How many things am I using? I'm giving you a lot of things. Eh? It doesn't cost you anything. Your phone is in your hand anyway. And some of you are even lying on the bed. Me that I'm still sitting like I'm in the courtroom. I'm facing the panel of judges. Okay. Rick Moses, how are you? Nancy, how are you? Oma, Lajoy. Okay, so we end the topic on that level today. Good night, everybody. Okay, so if you live